Hello, good morning. Hello, good morning.
Good morning, how are you?
Okay, let's finish the paper, this paper, the one that we started with. Then in our next class, then we can go to another question paper. So for now, let's finish this one. Then we'll go to another question paper in our next class. So let's start with we did part A and part B of the costing question that we were busy with. So let's do part C. Part C says during September 2024, PBFD had a standard costing system in place for the hamburger and sausage products only. There was no budgeted opening and closing inventory of any type. The following information was extracted from September 2024 actual and budgeted information. Right, then we go to the sales. On the sales, they are saying PBFD budgeted to sell 2,500 units of hamburgers at 375 per unit and 3,400 units of sausage at 350 per unit. Then due to lower than expected sales quantity in August, PBFD provided a 6% price discount on both the hamburger and sausage actual sales during September 2024. So this is going to be the price. So this is going to be, remember, this is our budgeted price. And when we go to the actual, it means we should take into account the 6% price discount. Right, then they say due to this initiative, PBFD reached 110% of its hamburger and 100% of its sausage budgeted sales volume. So when you want your actual sales, it means you come here. There is 110 for the hamburger and 100% of the sausage, right? Then this is our direct raw materials. We have the standard direct raw materials required for 1 unit of sausage. Then we have the actual direct raw materials purchased and each to the sausage. So here is our standard, and this is going to be the actual. Let's check what are we required to do before we read much. Right, our question requires us to, for answering part C only, assume the following. A standard costing system is in place. The implications, if any, of opening and closing inventory should be ignored. So our CA says calculate the hamburger sales price variance for September 2024. So here we are required to calculate the sales variance for so in our A, we are required to calculate the sales variance. So this is our CA. We need the sales price variance. Right, where do we start? We want the sales price variance for the hamburger. We want the sales price variance. So the first thing that you need to do is your formula. You need your formula for sales price variance. So when you are doing these variances are very easy. When they say the sales price variance, it means you are looking at the difference in the budgeted sales price and the actual sales price. That's basically what you are doing. So which means you need to determine the difference in the price. If the question says quantity variance, it means you are looking at the difference in the budgeted quantity and the difference in the actual quantity. So the keyword is here, the sales price variance. So we're looking at the difference in the price from the actual and the budgeted. So which means you just come here and say actual price minus your what? Your standard price times your actual quantity. That's how you determine this. So we go to our question and look for the information that we want. We want the actual price right? So our actual price is going to be who? How do we determine our actual price here? We need this one. So this is the standard price. And who is the actual? The actual price is 60%, 6% price discount. So we're going to give discount on this one. And due to this initiative, they've reached 110% of its hamburger. So how are we going to build it on our answer? So we need to have the actual price here and the standard price and the actual quantity here. So it's going to be, the actual price is going to be 375 times what? Times 94%. Then minus 375, that's the standard price. Then it's going to be times what? Then these are the budgeted, but remember they say due to the discount, they are going to have 110%. So it's going to be 2,500 times 110%. So that's how you build your formula there. So let's go and fill in. So which means we are going to have our actual price here is going to be, we say our actual price is 375 times 94% minus the standard price is 375 times the actual quantity, it's 2,500 times 110. So that's how we build it. So how much is it going to be our here? We need this one, 375 times 94%. So this one is going to be 352.50. I don't know if we can round it. Or we can leave it like that. So this is going to be 352.50 minus 375. Then here is 2,500. Then we adjust that one. It's going to be how much?
2,750.
2,750. Right, so we come here first. But before you go any further here, you should be able to tell whether you're going to have a favorable and or unfavorable balance here. Are we going to have a favorable or unfavorable variance here? Anyone who can pick from what we have here, because here you should be able to see whether we're going to have a favorable or unfavorable variance from what we have now.
I think it's unfavorable because the actual was less than the standard or budgeted.
Yes, the actual price is less than the budgeted price. So it's going to be unfavorable. So let's see how much is it going to be. 375 minus 352.50.
22 rand 50.
So it's going to be 22 rand 50 times 2,750. Then we have how much there times 2,750.
61,875.
61,000. So this one is unfavorable. You can just put U, or you can put the full word unfavorable there. So you will be done with your A, sales price. When you do your variance, if they say sales price, it means you are comparing the prices. I think in variances, we only have these two. It's either a sales, it's a price. It might be material quantity variance, but they will be talking of quantity here, which means you are looking at the difference in the quantities that were budgeted and the different and the ones that were used. That's basically what you'll be looking in standard costing. This is not a big topic, but what you need to understand is here. If they say a sales quantity variance, it means you are comparing the quantities here. If they say price variance, it means you are comparing the prices. That's all the standards. That's what we'll be doing when we're doing variance analysis. It will only be different. Maybe we're doing labor, but we're looking at the same thing, right? So let's check the second one and see, unless if there's someone who needs a clarification on this. I want you guys just to understand how do you build your, right? So our B is going to be calculate the sunflower oil purchase price variance for September 2024. We want the sausage only. Oil purchase price variance for the sausage. Right, so let's start with building our formula. So we are here on C. On B. So we need the oil purchase price variance. So here we need the sausage. Right, so the first thing in your standard is to build your formula. It's easy if you have your formula. It's a purchase price variance. Purchase price variance. So which means we need the actual with what is it, purchase price or quantity? Is price, ne? So we need our actual price minus our standard price times what? Actual quantity. So that's how you build your formula for there. So let's go and see our figures there. We want the oil, sunflower oil purchase price variance for the sausage. So we are here. So they say the standard raw material required for 1 unit of sausage are. So here, as we want this one, the sunflower oil purchase price variance, we want this one. So this is the standard direct raw material, which is 0.75, and the price per unit is 19 rand 50. What else do we need? Remember our formula, we say actual price minus standard price times the actual quantity. Right, so what are we going to do? What is the actual price here? These are the standards that we have here. How do we determine our actual price and our standard price? These are the actual. So which means we are here on actual. What does it, so which means our actual price is going to come from here. Am I correct? Was the actual direct raw material purchase and each to the sausage production were as follows. So this is going to be our actual. So it's going to be 54,352 over 2752. So this is going to be our actual price. then our standard price is going to be here. Sunflower oil, but remember this is standard kg per unit, and this is a full unit. So which means here we are looking at 0.75 kg. This one is including, it's for a full unit. So which means we need to adjust here. We need to adjust this 19 Rand 50. We need to adjust it so that we can have the price per kg. So this is where your understanding of how many kgs are there in here and how many are here, so that at the end of the day you can be able to convert this to because here they are saying standard kg per unit. So this 0.75 is 75 grams. So you need to know how many grams are there in a kg. Is it not 100? Am I correct? Are we together there? Times 19 Rand 50. So that you can have the one per 0.75 kg. So which means when you go to fill in, you already have your actual price here, and this is going to be your standard price, and this is going to be your actual quantity. Remember here they are talking of material purchase price variance. So these are the actual sunflower oil that we purchased. I don't know if we are together, you guys here. So this one is the sunflower oil purchase price variance. Right, so our actual price we say is going to be what? 54 352 over 2,752 minus our standard price is going to be 100 over 75 times 19 Rand 50 times actual quantity is this one times 2,752. I think that's how it should be. So how much are we going to have there? Let's start with the first one, 54,352 divided by 2,752. It's going to be how much there? 19 Rand 75. So this one is going to be 19.75 minus here is going to be 100 over 75 times 19 Rand 50. So this one is going to be 25.99. I'm not rounding. Let's just use them as they are. Right? Then we say times 2,752. So we look at here. Are we going to have a favorable or unfavorable? Actual price is this one, and standard price is this one. Are we going to have a favorable balance variance here?
Yes, we're going to have a favorable balance.
This is actual, and this
No,
is...
I think it's an unfavorable.
Oh, yes.
Yeah, it's unfavorable. Right. There's
It's
something else
unfavorable.
that I want to explain there. Always take note when you are doing your cost variances. Remember, there's a difference between cost variances and sales variances. So this one is a cost variance. So you were planning to use 25 Rand 99 and you end up using 19 Rand 75 because this one is a cost variance. So which means it's a favorable to you. But if it was a sales variance, you were planning, let's say if it is a sales variance here, the the the, the, the standard price here is 25.99 and the actual is 19.75. So if it was a sales variance, then it's going to be unfavorable. I don't know if you guys can. So always take note. Are you doing a cost variance or a sales variance? All cost variances, if the actual is less than the standard, then it means it's going to be unfavorable because it's a cost. You were supposed to use more, but you end up using less. So it's going to be a favorable variance. So that's basically how you, so how much are we going to have here? So it's going to be minus 19.75. So this one is going to be 6.24 times 2,752. The most important is not these answers that we are having here. What is important is to understand, because remember, we're not going to have the same question paper like this one. So here we're just trying to illustrate so that when we have the questions, exam questions, then we know how to build our standard costing. So this is going to be your, so we say it's a what? Is it a favorable? It's favorable, am I correct?
Yeah. Yes.
Yeah, it's favorable. It's easy to tell if it is a cost variance. You can even on your own. If you let's say you went for a shopping a window shopping where you just check the prices, then you found that no something is 25 Rand 99. On the day when you go to purchase, you found it here. So it's a favorable on your side. But if you are selling something but you were planning to get this 25.99, then you end up getting this one. It's unfavorable because it's an income that you wanted to receive and it has gone down. So that's basically how you compare these variances. Right? Unless if there's someone with a question, let's go to the next question. I don't think you should not struggle with variances. The moment you see your question paper, if you check this topic, that's the topic that you should quickly go to. So in our C, they say calculate sausage direct material yield variance for September 2024. We want the yield variance. Yield variance is more or less like the material mix variance. So when we are doing the yield variance, we are looking at the budgeted yield, what we were expecting to be the outcome from our budget, and what was the actual outcome from the material that we used. That's a material yield variance. So which means we are looking at, you have a material mix and you were expecting a yield from that material mix. This is what you were expecting, and this is what has come out. So that's how um, you determine your yield variance. You were expecting an outcome from the mix of material. But remember, when it comes to the mix of material, it might be a process So in that process, you may find that some of the material might evaporate, all those things, which means your material, your budget and your actual will end up different because of the loss in the process. So we want to determine that material yield variance. Right. So in your material yield variant for the sausage, what you do is you come here to your question. We are looking at the material yield variance for the sausage. Right. These are the standard direct raw material required for 1 unit of sausage. And these are the actual direct raw material purchased in each to the sausage production. So these are the actual raw material. These are the standard raw material. So what you are going to compare in you look at the actual yield and the standard yield. You look at the actual yield and the standard yield. So our actual yield is going to be determined by what was produced in terms of the sausage. The actual quantity produced for the sausage is how much here? It's 3,400. Am I correct? That's the actual, because they say it's going to be 100% of each sausage budgeted sales. So which means if we multiply it by 100, it's still going to give us 3,400 here. So that's the actual yield. So you compare your actual yield uh, with your standard unit, standard kg per unit. So which means you compare with the sunflower oil, the wheat and the sunflower and flavorings. So these are going to be your standard kg per unit. Then you now come here and look at the actuals. So your actual are going to be here. These are your actual. So in your actuals, when you are doing your mix variance, you need to put them in standard proportion. So which means you are going to put them to this standard. I think we did this something like this before. Let me just come down and write the formula first. Then we can start from there, from the formula that we have. If you check in our notes, we have this material mix variance and material yield variance. So this is going to be our C. It's material yield, not mix, it's material yield. Right. I will always prefer us to do it in a table form, this one. So your formula for this one is going to be your actual yield minus standard yield in actual input. Actual input then you multiply by what? by the standard cost, standard price. So this is going to be your formula. So I would always prefer you to use, when you are doing your material yield variance or your material mix variance, you must do it in a table form. So let's see how can we build our table. So which means here we're going to have the material itself, which was used. Then we're going to have the actual yield. The actual yield or actual output. Then here we're going to have what? You can have your what here? Then you can have your actual in standard proportion. So that's here. Then here, you are now going to have your standard. You can have your difference here. Then your standard price. Okay. Then you can have your standard price. So this is going to be a difference. Then you have your standard price. Then here you can now have your what? Your variance. Right, so that's the table that you should have. So here you come on your material, you come and input the material. So your material yield is going to be made up of, here we have the textured. Um, then we also have the sunflower oil. What else do we have in the material? We also have the wheat and flavoring. Right, so that's there on the table. Let's see. So what we need now is to determine the actual yield. Let's have the actual yield first. How do we determine the actual yield? Any idea from you guys? If you check from our notes, we have this, I think we did them like, our first class was those simple variances. Then we had to do these ones in our second class when we were doing classes. Right, so let's look at how do we get the actual yield output and how do we get the actual usage in standard proportion. Then once we have them, then it's going to be easy now. The prices are not a problem because the prices we're only going to check this one. The standard prices we're going to check this one. So our standard prices are here. There is 14, there is 1950, 64, 35. Those are going to be our standard prices. So we have 14, 19.50, and 64.35. These are our standard prices. Then what else do we want? We want the actual yield. So when you do your actual yield, you come here. Remember, we're dealing with the sausage. So in your actual yield, you go to the actual quantity for the sausage. It's 3,400 units of the sausage. Then you come and see how many per unit, which means you come and adjust here. These are 3,400 units, and textured soya protein need 1 kg. Then this one needs 0.5. Then this one needs 3.7, 3.25. Then you adjust your kg per unit. Then you go to the standard in actual proportion. Then it means you come here. These are what was purchased and issued to the sausage. Okay, so let's look at how do we do it here. Okay, so we need a calculation here. We need a calculation here. So here is going to be our total variance here. So we need a calculation for these ones. So we need the first calculation that we want is the actual yield. So in our actual yield, we have number one, we have 1 kg times 3,400 units, which is going to be 3,400 what? Kg. Then in our second, so this is our one. Then our two is going to be, we have 0.75 times 3,400. How much are we going to have there? 2,550. Are we together on this one? 2,550 kg. Then on our number three, we have 3.25 times 3,400. It's going to give us how much there? Are you guys there? Are we together here? It's going to give us 11,050. Right, so we have our kgs. Then what we want is another calculation for the actual usage in standard proportion. So here we need another calculation for actual usage in standard proportion. Right, so in your actual usage in standard proportion, you come here, Let me just go to the question. Right, so we are here, we want the actual usage in standard proportion. So you are going to add this, then you see from the total, then you use your mix here to see how much of the total is going to go to the textured soya protein, how much of the total is going to go to the sunflower oil, and how much of the total is going to go to the wheat. So we use our standard mix. Our standard mix here is going to be, for here is 1/5, for here is 0.75 over 5, for here is 3.25 over 5. So the first thing that we want is this total. Let's have that total. So it's 3784 plus 2752 plus 10664. So it's going to be 17,200. 17,200. So you come now and fill in on your answer book. Right, so let's see how do we fill it here in our. So which means here we are going to have our 4, let's just put it as 4, actual usage in standard proportion. So it's going to be 1/5 times 17,200. How much are we going to have there? 3,440. So that's number 4. Then number 5, we're going to have 0.75 over 5 times 17,200. Then our number 6 is going to be something just. Right, then this one is going to be 3.25 over 5 times 17,200. So let's have this figure so that we can go and fill in. So it's going to be 0.75 divided by 5 is times 17,200. So this one is going to be 2,580. Then let's go to this one. It's going to be 3.25 divided by 5 times 17,200. This one is going to be 11,180. So we have our figures now. So we can go and fill in our, so this is, so this one is going to be 11,050, 2,550, 3,400. So this one is going to be 3,400, and this one we say is what, 2,550. Then we go there. Then we come and take this one. It's 3,440 and 2,580 and 11,180. So we come and fill in here. So this is going to be 3,440. So this one is going to be 2,580. This one is 11,180. Let's look at the difference. This one is going to be how much? 3,440. So this one is going to be 40. Am I correct? Then this one, 50 and 80. This one is going to be 30. And here, this one is going to be how much? I'm getting 130 here. Right. So let's determine, are they going to be favorable or unfavorable? That's another thing that we should look at here. This is a yield variance. So in your yield variance, what you look at is this is the actual output and this is the standard output. So which means this is a yield. You were expecting to get this and you end up getting this. So it's going to be unfavorable. And here you were expecting to get here and you end up getting this. So which means it's still going to be unfavorable. And here you were expecting to get this, you end up getting this. So all of them are going to be unfavorable. Then we go to the standard price. The first one is what? 14, 1950, and 64.35. Then we need our variance. The first one is going to be how much there? 40 times 14, 560. It's unfavorable. Then the second one is going to be 30 times 19 Rand 50. This one is going to be 585. It's unfavorable again. Then this one is 130 times 64.35. It's going to be 8,365 point 50. It's unfavorable again. It's unfavorable again. Then we need our total. We can come here and put our total here. They are all unfavorable. So we just add the plus 560 plus 585. So it's going to be 9,510.50 is unfavorable. So that's the total there. So that's how we do. And don't confuse material yield variance and material mix variance. They are a bit, they are more or less like the same, but there's a difference in them. If it was a material mix variance, it means we're going to have our standard mix Then we have our actual mix. We compare our standard mix versus our actual mix. Right? Unless you guys have a question on this one, let's look at the next one. Who is next? Any question on this one? Unless if there's someone with a question here, we can go to next. Right, so the next one that we have is here. We are on G, calculate the total variable manufacturing overhead efficiency variance for September 2024. We need the variable manufacturing overhead efficiency variance for September 2024. Where do we start with this one? We need the formula first. Whenever you are doing your variances, the most important thing first is your formula. So this one is going to be the total variable manufacturing overhead efficiency variance. So which means we need to have a total for both of them. So let's check on the information that we have so that we can see if we can be able to do it. Right, so this is the variable manufacturing that we have here. So we are on 3.3. They say variable manufacturing overheads. Variable manufacturing overheads are allocated based on machine time used in the production of each product. The budgeted variable manufacturing overhead recovery rate per machine hour is 42 per hour. That's the budgeted variable manufacturing overhead recovery rate. And the budgeted machine time to produce 1 unit of hamburger and sausage is 102 and 117 machine minutes, respectively. The total actual machine hours were 11,370 hours, and the actual rate was 44 rand per machine hour. Where do we start with this one? We want to see the variable manufacturing overhead. So what are we calculating here? That's the first thing that we need to determine. What exactly are we calculating here? We want the variable manufacturing overhead efficiency variance. What are we calculating?
I think we're calculating the hours.
Yeah, we need to see the budgeted hours and the actual hours here. But what you should look at, they say in total, there's a trick that I saw here. They give us the actual machine hours, which means when we do our calculation, we cannot separate them. We need the total hours for the two products. But if they could have said here the actual, we could do the variance separately, then we add the variances. But in this case, it's easy for us to get the total hours, which means we are going to add the hours for the sausage and the hours for the other product. So that's basically what you should look at. In your exam, the most important thing is to figure out, make is something that needs you to be good in quickly figuring out what needs to be done. That's why I always say understanding your topics is very important, because figuring out in the exam, it needs someone who understands his topics very well. Right, so let's check what I'm going to do here. We need the how many hours per product. So here they say each product is 102 and 117 machine minutes. So we need to convert to hours. So which means we should come here. This one is 2,500. Then what is going to be the actual? We adjust it with this one. Then this one is still going to be 3,400 because we adjust by 100. So that's basically there. I think we are fine there. So we can, let me just put our T here. There's a space for T. So here we are looking at the total variable manufacturing efficiency variance. Right, so you come and your formula first. So we want the efficient variance. The moment they talk of here, which means we are looking at the hours. So we are going to look at the standard hours minus the actual hours. Times what? Standard variable manufacturing overhead. Variable overhead rate. Right, so this is what we are going to do. So in our standard hours, we are going to add the 2. So which means the one is 102 per unit. So let's convert it to hours. So it's going to be 102 over 60 times 2,500. We adjust it by 110. Then we add the one for the sausage is 117 over 60 times 3,400. Then we minus what? 11,370 times the rate is 42. I think that's where it is. So let's start from here and see. The first one, we need the hours for the first product. So it's going to be 102 divided by 60. Let's start by adjusting this one. Sorry. So it's going to be 2,500 times 1.10. So it's going to be 2,750 units. Then 102 minutes per unit. Then we need the hours there. So it's going to be 102 divided by 60 times 2,750. So here we're going to have 4,675, then plus 117 divided by 60 times 3,400 is going to be how much there? Plus 6,630. minus 11,370 times 42. So we need this part, 4675. So this one, 11,305. So this one is going to be 11,305 minus 11,370 times 42. What are we going to have here? Are we going to have a favorable or unfavorable? These are the standard hours that we have here. These are our standard hours, and these are our actual hours. Are we going to have a favorable? These are our standard hours, and these are our actual hours. Are you guys there? Are we together here? What are we going to have here? Is it favorable? These are hours. It's a cost variance. Hours are just like cost variances. Because you are looking at, you were expecting to use 11,305 hours. Then you end up using 11,370. So is it a favorable or unfavorable? That's what you are looking at here.
It's unfavorable.
Yeah, remember I said to you guys, when you are doing your variance, look at, are you dealing with a cell? In fact, let me just put it in, sales variance or cost variance. The moment you put it in its right category, then it's easy for you to determine whether it's favorable or unfavorable. Because if it is a cost you were planning to use here, and you end up using this, so which means it's unfavorable in this case. So let's look at by how much. Minus 11,370. I'm getting 65 times 42. So this is going to be, I got 2,730 unfavorable. Then it will be done there. I want us to, we're going to leave some of the questions. I want us to do B, D, and C. I think on the variances, unless if there's someone with a question on the variances, I think these are the variances that we have here. And I want you guys to check in our notes here. Be able to do this one on the variances. I want you to go and look for material mix variance and the material yield variance. I think those two, go and look for them and see the difference between them when you look at the notes, when you are alone, when you have your own time. Look at the material yield variance and the material mix variance. Because in the exam, these are the variances which has more marks. So, meaning to say, if you know how to calculate the material mix variance and the material yield variance, on the variances, the rest are not that bad, right? Unless if there's anyone with a question, I want us to do D and E today, so that when we come on Wednesday, we must look at another paper. We're now going to look at our actual paper. Remember I said when we started here, we're trying to refresh ourselves from the costing principles. Then when we come now, then we look at the whatever paper. I think there's 2020. We can start from the 2022 and then we'll go to the 2024. If there's still time, we can look at another one. But I don't think there's time because I saw someone who sent the timetable in the group. So which means there is no more enough time for us, which means we have to be, and it's likely that we are going to have our classes for Mac now it's going to be Saturday and Wednesday. The way I see it is like it's going to be Saturday and Wednesday. If you guys are free, but me, I will be there, I will be available. So which means for Meg, we are going to try to do Meg Saturday and Wednesday. So let me look for another question that we can do there. It's still from the same question paper. Let me check. Okay. Let me just share another question. I think you guys, you can see my part E. Let's quickly do part E. Then we'll do part D. We have to finish because we don't want to do this in our next class. So let's do part E. Then we can do part D as well. Right, in our part E, they say PBFD is currently allocating fixed manufacturing overheads to products using machine hours as a basis, the traditional approach. They are using machine hours as a basis. However, they are investigating using activity-based costing. This is one of the topics that you must know, the ABC and the traditional. Remember here, when you are doing your, it's either this, in your exam, remember it's integrated questions more. Remember in your 3761, it's a more integrated than this one. So what I'm saying here is activity-based costing, you can find it combined with absorption costing. Then they want you to apportion the fixed manufacturing overheads using activity-based costing. So you must be able to use the activity-based costing system, right? So they are using activity-based costing system, as this system recognizes the complexity of manufacturing and its multiple cost drivers. The information was extracted from the 2025 financial year budget. That's the information that we have there. Total budgeted, let's look, I always want to look at the question. What are we supposed to do? There, they want us to calculate the difference in the budgeted fixed manufacturing overhead allocated to each product due to the change in allocating the total budgeted fixed manufacturing overheads from the traditional approach to ABC for the 2025 financial year. Assume that the margarine is discontinued around your to 2 decimal places. Then round your final answer to the nearest run. Right. So what are we going to do here? The first thing in your exam is to understand the question. What are you supposed to do? Like in this case, what are we going to do? They say calculate the difference in the budgeted fixed manufacturing overhead allocated to each product due to the change in allocating and total budgeted fixed manufacturing overhead from the traditional approach to ABC. So where do we start with this kind of a question in the exam? Where do we start with this kind of a question in the exam? Anyone with an idea? What are we supposed to do? Well, that's the most important thing in your exam. What are you going to do? You have this question in your exam. What are you going to do? Where do you start? What are you calculating here? Right. When you have this question, automatically it tells you that you want to compare the difference, which means you need um, the fixed manufacturing overhead allocated to each product using the traditional costing system and the ABC. So which means you are going to calculate ABC allocated overheads per unit and the traditional per unit. Then you look at the difference between the two. That's what you are. So in your calculations, it means you are going to calculate um, the overhead per unit using the traditional method and the overhead per unit using the ABC. Then you compare the two. So that's basically what we are doing, what we are going to do here. So let's see where do we start with this one? This is our E. So in our E, we want to determine the difference. So where do we start with this one? Let's just check the question. Right, so here they now go and say the budgeted machine time to produce 1 unit of the hamburger and sausage is 1.6 and 2 machine hours respectively. The budgeted production units are 30,000 units and 42,000 units of the sausage. An initial analysis of the fixed manufacturing overhead established the following relationship between the activities and the overhead. So we have the material ordering and handling. These are the total cost. So when you are activity-based costing is the easiest topic on all our MSc topics. Because if you check, they will now tell you how do you allocate. You go to one. One will say there are 48 working weeks in the financial year. The direct raw materials are ordered and received every three weeks for hamburger and every 2 weeks for the sausage. You see, so which means you need to look at the number of orders here. So if they are ordering every 3 weeks and there are 48 weeks, so you just divide into here to get the number of orders, and then you get the number of orders. So when you allocate to the products, you are going to use the number of orders. The same applies when you go to the flash freezing process. They will now say units are placed on custom-made freezer shelves before being loaded to the flash freezer. One hamburger shelf holds 150 units of hamburger, and one sausage shelf holds 200 units of sausage. Hamburger units cannot be pegged on sausage shelf, vice versa. So which means flash freezing process, you are going to use the number of shelf here. So you go to your units, there is each shelf holds 150 units. So you need the number of shelves here. Then here you need the number of shelves here. Then number 3 says every 500 units of hamburger and every 400 units of sausage is going to be quality inspected. So here you need the number of quality inspection. So you just go to the units and see how many quality inspection for the hamburger and how many quality inspection for the sausage. That's basically how you do this, right? So the budgeted production units are 30,000. And so let's start with the first one, the material ordering and handling. Then we go to the flash freezing process and the quality inspection. So let's start with the first one there. I'm just trying to figure out how do we put it here on our so I think we should do a calculation for our cost drivers. Can start here. Let's start here and see the cost drivers. So our cost drivers, we have number of orders. So our number of orders is going to be how many? We have, I think we should have for the two. So number of orders we have for so for this one, it's going to be what? It's going to be, how do we determine the number of orders? They say there are 48 working weeks in the financial year. The direct raw materials are ordered and received every 3 weeks for the hamburger and every 2 weeks for the sausage. Let me just put it like this. So we want the number of orders here. So it's going to be for the hamburger is 48 divided by 3. Then the other one is going to be 48 divided by 2. So 48 divided by 3 is how much? It's going to be 16. Then by 2 is 24. Right, so that's the number of orders. Then we can now look at another one, which is the number of shelves. The number of shelves is going to be, the units are placed on custom-made freezer shelf before being loaded. One hamburger holds 150 units and 200 units for the sausage. So the number of shelves, we just come here and say, we need the number of shelves. So the number of shelves is going to be 30,000 divided by 150 and 42,000 divided by 200. How many shelves are we going to have there? So the first one is 30,000. So this one is going to be 200. Then the second one is going to be 42 divided by 200. It's going to be 210. So that's the number of shelves. Then the last one is going to be what? Number of inspections. Sorry, number of inspections. Right, in our number of inspection, they say 500 and 420. For every 500 units, they are going to inspect here. So it's going to be 30,000 divided by 500 and 42,000 divided by 420. So how many inspections are we going to have there?
We're going to have 60 and 100.
60 and 100 here. Right, so these are the number of inspection. I think we're done now. So now we now want to allocate the fixed cost to the products. So we can do here. So we now have our allocation rates. So we can now allocate. So here we're going to have the right. So in our allocation, we just use what we have. So we start with the material ordering and handling. Then we are going to have quality inspection. Right, so that's it there. So what you look at now is you got your, so these are for material ordering and handling, we have this one. Then for flash freezing process, we have this. Then for quality inspection, these are the total fixed cost. So we are now going to use our here number of orders, which is 16 for the hamburger and 24 for the sausage. So we're going to add the 2, then we get 40. So it's going to be 16 over 40 times 6,686,000. Then the other one is going to be 24 over 40 times 686,000. Then when we go to the freezing, it's going to be 200 plus here, it's going to be 400, 410. So it's going to be your 200 over 410 times 1,394,000. Then the other one is going to be 210 over 410 times 1,394,000. Then we go to the last one, is 60 and 100. So it's going to be 60 over 160 times 560,000. Then the other one is going to be 100 over 160 times 560,000. Right, so that's there. So let's have the figures. Let's start with the first one, 16 over 40 times 686,000.
It's 274,400.
274,400, and this one is going to
It's 411,600.
411,600. Then we could go to the next one. The next one is going to be what?
680,000.
This one is 680,000. Then this one,
714,000.
then the last one is going to be the last one is going to be 210 here.
Mhm.
Then 350 here. Am I correct? If I'm wrong, just correct me. Then we need the total for the here. Remember our gain, we are trying to calculate the fixed costs allocated to each product per unit. So which means we need the total here so that we can divide by the number of units. We'll need the total here so that we can divide by the number of units. So let's have the first total here.
It's 1,164,400.
1,164,400. And here 1,000,000.
475,600.
500. 475.
600.
600.
Yes. Yes.
Right? So that's it. So we have our total here. Our total overheads allocated. Right, from there, what do? We want the overheads per unit. So which means we need now the number of units. So here we have 30,000. Here we have 42,000. Am I correct there? Then what are we going to have now? We are going to have ABC, fixed manufacturing overhead per unit. We just divide 30,000 into here. How much are we going to get? 1,164,400 divided by 30 is going to be 38.81 here. Then here we divide the same thing, 1,475,600 divided by 42,000. So this one is going to be 35.13 ABC fixed manufacturing overhead per unit. So what are we going to do? We now have our ABC fixed manufacturing overhead per unit. How are we going to share the one for? So we want here, remember the question wants us to compare the difference. So this is our ABC fixed manufacturing overhead per unit. So which means we need traditional cost. Right, so we need the traditional cost fixed manufacturing overhead per unit. What are we going to do on the traditional cost here? The total budgeted annual fixed costs are 2,640, and the budgeted machine time to produce 1 unit of hamburger and sausage is 1.6 and 2 machine hours. And what else do we need? The allocation basis. They use machine hours to allocate products to fixed manufacturing overhead to product. So what are we going to do there? Any idea, anyone with an idea there? What are we going to do? We have the budgeted production units are 30,000 and here is 42,000. What are we going to do? I think we should convert this is to machine to hours here. Sausage is 1.6 and this one is 2 machine hours per unit. Right, so let's see how we can put it on paper. They allocate based on machine hours. So which means we need our machine hours. So our machine hours is going to be, because here they are allocating based on machine hours. So let's look at how many machine hours are we going to have. So our machine hours are going to be 1.6 times 30,000, then 2 hours per unit times 42,000. So here we're going to have how much there? 1.6 times 30 is going to be 1, 2. How much are we going to have? 48,000. Then here it's going to be 84,000. Am I correct? Then what is going to be our total there? One, 132,000. So what are we going to do now? We have our total hours. What are we going to do? They allocate based on machine hours. So what are we going to do? We have our total machine hours. Are you guys there? We have our machine hours. So what we want now is to allocate how many, what is the overhead rate per unit using the traditional method. So it's going to be now your overheads divided by the machine hours. So how much is our overheads here? The total overheads is 2,640,000. So it's going to be So our overhead per unit is going to be 2,000,000 640 divided by what? By 132 hours. 132,000 hours. How much are we going to have there?
$20.
20. So this is going to be our for here and for here. So the difference is now going to be what? 38.81 minus 20 is going to be 18.81. Then this one is going to be 15.30. So what do you suggest? Let's say the question was saying analyze the overhead rate allocation between these two. What do you think are the advantages here of the traditional cost? Anyone who can look at looking at what we have done here, these are the ABC fixed manufacturing overhead per unit, and these are the traditional overhead per unit. What can you recommend the ABC, or you can recommend the traditional cost here? Anyone who can recommend, which one can we recommend? Can we recommend ABC or a traditional cost? Because the question will give you, like in most of your questions for 3761, this can be a calculation that is provided. Then you are required to recommend which costing method, which allocation method should they use here. What can you recommend based on the figures that we have here? Are you guys ready for next week? I don't see you guys ready. These are the things that we should. They must be in our head by now. We are almost. I think it's almost 2 weeks to the exam. Make is something that even if you know it, the moment you see the paper, it will confuse you totally. So, which means for you to be safe, you must know it very well so that you get confused a bit. Everyone, even myself, when I see the question paper, it confuses me, but it doesn't totally confuse me. It confuses me a bit. So this is a situation that everyone must be in when they are going to the exam, so that you don't become too confused. Right. I think we're done there. What I wanted you guys to say on this one is, if you can look from these numbers, you can tell that if you are the management accountant of a business, you can recommend the ABC. Why? Because if you recommend ABC, it means you are going to cost your product accurately here. If you can check when these guys are using the traditional cost, it means the cost of their product is not up to the cost, the actual, the actual cost of the product, which means they are undercharging. So at the end of the day, if you are undercharging the cost, you will find that these guys will now say we're going to put a markup after they add this cost. It's not a markup. Already they are still operating under the cost price. They don't have a markup. So which means the one is this one. That's the one with an advantage, the ABC, which allocate fully the cost. Right? I think that's what I wanted you guys to say there. So that because when you are doing your study, look at whichever way the question can come. Remember, we don't have one fixed way of question. So the first thing that you guys must do like now, if you don't understand the topic, if you come across a question that you don't understand, don't even try to, even if there are answers somewhere, don't even try to use the question and answer that are available. As long as you feel like you don't understand it, you can use your answers later, but first go to the topic so that you understand the principle behind. Because if you master how it was answered there, tomorrow it will be asked in a different way. So which means you won't be able to answer it because you will just practice another format. So the most important thing in our Mac FAC is to understand those topics. So that the moment you see a question, you can answer it in whichever way. You don't have one way of answering a question. You understand it, which means whichever way it is asked, you can still be able to answer it. Okay, unless if there's anyone with a question on the activity-based costing, I want us to do D, a bit of D, so that we can end there on D. Let's do D. Let me just share my D with you. Right. I think you guys, you can see my D is still from that same question paper. Remember, we say we want to finish this one today. We no longer want, we will be doing a new question paper on Wednesday. And it's likely that we are going to have to make Saturday and Wednesday until we write. If you guys are available, there I will be available unless there's a challenge. Because what I want is, you know, this module, I know it becomes a problem last minute. So I don't want you guys to go to the exam without a full understanding of this module, because Make is one of those modules that can surprise us when the results come. So we need to work together so that at the end of the day, you guys will go to the exam knowing exactly what you are going to do in the exam. Besides that, then we'll have another challenge for, it will be a challenge. Because this module, I know these lecturers will make last minute, they can just disturb your whole year last minute. So let us try to be very strict with our Make, especially this remaining time, so that we fully master this module. Right, so I want us to do D. D, let's look at what D is saying. Like D is saying, during a PDF executive committee meeting, the idea of discontinuing the margarine product from 1 November 2024 for 2 financial years. Okay, they wanted to discontinue it for 2 financial years. Pressure on profit margin and negative press surrounding the quality of the product was raised. So these guys, they want to do a discontinue. The moment you read the word do discontinuation, then you know which topic are you looking at. Here you are now looking at relevant cost. You want to advise management whether they have to discontinue or not. So which means you are now looking at relevant cost. That's the first thing in your exam. Know the topic. The moment you read the scenario, it's you relate it to a topic so that you can now apply that topic. That's all how you should do your MAC. If you read something, then the next thing is to relate it to a topic. Which topic am I tested here? Then you just apply that topic. You won't even get much lost if you do it that way. But if you cannot determine which topic is here, you are going to answer this question wrong. So in our case, we are doing relevant costing, right? Then they say the product can be relaunched under a new name if the market circumstances allow it. You have gathered the following information. I don't expect you to read this whole information, especially once you determine that you are dealing with the relevant costing. In relevant costing, you don't have an order. You can put it in any order, this information. Then let's look at what are we required to do. Here, we are saying from a quantitative perspective only, advise PBFG if the margarine should be discontinued. Where do we start when we have this kind of a question? We want to advise if they can discontinue the margarine. Where do we start? We want to advise if they can discontinue the margarine. Where do we start? Where do we start with this one? You guys are not there. Do I have to end this class? Because I don't see why people are just quiet. Me, I don't feel comfortable when I have a class with people who are not here. Or who are tired, we can end the class because at this point, I'm not the one who should be telling you the answers. I should tell you where you get wrong at this point. Most of the things at this point, you guys, you must know them. At this point, because it's only 1 month to the exam, we've been doing Mac from March, which means we now know most of the things. So if I'm the one now who is just dishing out these answers, it's going to be a serious problem now in the exam. Like where do we start with this one? Are we going to, what are we calculating here? We want to determine whether to discontinue or not to discontinue here. Where are we going to start? Because you are the management accountant of PBFD, and you want to determine whether you should discontinue or not. What are you going to calculate here? You want to determine whether to discontinue or not. So what are you going to calculate? You want to discontinue, you want to determine whether you have to discontinue or not. So what are we going to calculate? You calculate the profit or the income or the relevant cost of discontinuing or relevant income of discontinuing and relevant income of not discontinuing. That's basically what you look at. So which means here you are looking at the relevant cost, the relevant income and the relevant cost. So when we are dealing with relevant cost, it means we are looking at relevant income and relevant cost. Then we have our net relevant income. So if you look at the two, the one for discontinuing and the one for not discontinuing, if the income for discontinuing is greater than the income for continuing, then it means you don't discontinue. That's all about business, because in business, it's all about profit. Nothing else they don't save us. Those people in business, they are there to save their companies to make profit. Right. So let's look at how do we put it on paper. So what you should look at now is you should look at like in this case, there are sales, there are raw materials, all this. So which means you can look at the income if you discontinue and the income if you don't discontinue. So let's see how you can put it in whichever way. There is no, but in some of the question papers, they can tell you how to put this. So as we are going to put it this way, if we discontinue the margarine, and if we do not discontinue, right, so I think that's how we can put it, so that we can calculate the profit of if we discontinue, the profit if we don't discontinue. Right, so let's start from the beginning where we start. So which means this one you can answer as you go like this. Number one says BFD sells 30 tons of margarine per year at a selling price of 40 kg per unit. Is it relevant? Yeah, I want you guys to look at relevant costing. Don't do the other costing here. We are doing relevant costing. So which means you should look at relevance. So is 4.1 going to be relevant? Is a relevant cost because they are saying they sell 30 tons of margarine per year at a selling price of 40 per kg, 40 per 1 kg unit. It's going to be, if they don't discontinue, it's relevant. If they don't discontinue, it's going to be relevant, this amount. But what you should also look at is 40 per unit, and they are 30 tons per year at a selling price. But here we're looking at to determine this for 2 years. So we should also take that 2 years into account. So we come here. So those sales, they can only get them if they don't discontinue. So which means they will come to this side. If they don't discontinue, that's when they will get the sales of 30,000 kg, 30 tons is 30,000 kg, because it's per kg, that 40 rand is per kg, times 40, then they'll get that income for 2 years. How much are we going to get there? It's 30,000 times
2,400,000.
2,400,000. So which means it's relevant. Here you should look at relevant cost. What is it relevant to on the discontinuation and the continuation? If something is not a relevant cost, you don't put it here. It's different from when we are doing absorption or direct costing here. So don't mix it. Put it in the relevant cost. Incremental cost. Remember, when we do relevant cost, we talk of incremental cost, which will be incurred as a result of that program. So if something is outside, if a cost is a cost which, even if you discontinue or not, you are still going to meet that cost, then it's not relevant to your decision. Right? You can also check on relevant cost. I think you will also see something there if you check on our notes in our class for relevant cost. So that at the end of the day, whichever way the question comes, you can still be able to do it. But let's go to 4.2. They say the direct raw materials and the variable manufacturing overhead cost were 8 rand per unit and 7 rand per unit respectively. What are we going to do with that one? So here we're looking at direct raw material and variable manufacturing overheads. If we don't discontinue, that's when we can incur this manufacturing overhead. Am I correct? Number two is relevant because if we don't discontinue, it means we are going to have a direct raw material and variable manufacturing overheads of 8 rand per unit and 7 rand per unit if we don't discontinue. So how do we put it now? So we have variable and direct material. They are relevant. So we're going to have direct material. So we also have variable manufacturing overheads. So here they say it's 6 rand. Is it 6? It's 8 on the face of here per unit. They make how many? Let's check. Double check what the question is. So here what saying it's 8 rand per unit and 7 rand per unit. Okay, so which means it's going to be times 30,000. Then we need to convert this one to 2 years. Then this one is the one with 7. 7 times 30 times 2 years. What you should look at here is this direct material is only going to be consumed if we don't discontinue. So which means it goes under discontinued there. So the first line, how much is it going to be, this one?
480,000.
So this one is going to be 480,000. Then the second one is going to be how much?
420,000.
So this one is going to be 420. If we don't discontinue, that's when we can meet this, right? So here on discontinue, we don't have this one. Right, so let's go to our note. The next note is going to be 4.3. It's 4.3. They say the total, this topic is very, it's not, you may not get total on this one, but if you know your relevant costing, I don't think you will face a lot of challenges with this topic. You might miss some of the calculations here and there, but I guarantee that you will get something out of this question. And so we are here now. They say the total monthly direct labor cost is 40,000, and 20% of the laborers will be retained and reskilled at a once-off cost of 8,000 and used to produce the remaining products. The remaining direct laborers will be retrenched at a total cost of 15,000. 8,000, is it going to be relevant? The reskilling is a cost, if we, it's now going to affect where?
Not discontinue.
Because if we discontinue, that's when
Yes.
we are going to incur this cost.
Mm.
So which means it's going to be a relevant cost if we discontinue. The same applies to the retrenchment cost. We can only meet this retrenchment cost if we discontinue. So which means these costs are going to fall under discontinued, the retrenchment and the reskilling. So that's how you understand your relevant cost. So if we discontinue, it means we are going to have those costs. If we don't discontinue, there is no retrenchment cost. There is no reskilling of those other labor force. Remember, the other labor force who are going to be reskilled, they are those who are within the production of the margarine, which is going to be discontinued. So, which means they have to be reskilled. So it's going to affect the discontinuation of the product. Right, so it's going to be reskilling cost. I think we'll be done by after. Let's just finish this question. Reskilling cost is going to be, we'll say it's 8,000. So this is going to be a cost. So there is also retrenchment. It's going to affect the discontinuation, the 15,000. Then it's there. And then let's look at what else are we going to do. There's that direct labor. What are we going to do with the direct labor? They say the total monthly direct labor cost is 40,000 monthly. So if we discontinue, if we don't discontinue, it means we're going to incur that cost. So we have to take it here. If we don't discontinue, it means the direct labor is still going to be there. So we go and say direct labor of 40,000 per month. Let's start with 40,000 per month. It's going to be for 2 years. Then times 12 times 2 years. How much are we going to have there? $960,000. It's 40,000, sorry here. So this one is a cost, direct labor cost. Then while these were there, if we discontinue, what is going to happen to the labor? This is another thing that we should look at now, right? If we discontinue, they now say the total monthly direct labor cost is 40. 20% of the laborers will be retained and reskilled at a once, and the remaining direct laborers will be retrenched at a total cost of 15,000. So what are we going to do with the labor here? If we discontinue, what is going to be the cost of discontinuing the margarine? Because here they are saying 20% of the laborers will be retained. So from 100, we are left with what? We are left with 20% of the laborers will be retained and reskilled at a once-off cost of 8,000 and used to produce the remaining products. The remaining direct laborers will be retrenched at a total cost of 15,000. So here, what we want is what? We want what affects discontinuation. So which means here we're going to have 20% has been retained, and this one that is going to be retrenched at a cost of 15,000. And what is the cost here if we discontinue there? So we're going to put it like this in our answer. So which means it's still under direct labor here. 40,000 is the direct labor per month. So it's still going to be 40,000 times 12. 12 is per month, times 2 times what? Times what? 40. Then how much are we going to have there? This one will be if we discontinue the measuring. It's going to affect the discontinuation here. How much are we going to have to discontinue the product? So it's going to be 40,000 times 12 times 2 times 40, 384, 384,000. So this is here, right? Then that's all about direct labors. Let's check if we have something there again. We have took the reskilling and we also took the retrenchment cost. Right, so which means we are now on number 4. Number 4 says the PB operation manager's monthly salary is 50,000, is allocated in the ratio of 40, 50, 10 to the hamburger, sausage, and margarine respectively. The manager who previously raised concern about his workload will only focus on the remaining products if the margarine is discontinued. Is number 4.4 relevant? Is it going to be relevant? 4.4. Anyone who can pick. If you guys understand relevant costing, you can tell what is going to happen to the salary of this manager if we discontinue. Is it a relevant cost? They still keep on paying this because he's now going to focus on is going to focus on the remaining product. And he is still going to be paid 50,000. So which means this 50,000 is not relevant. It's a committed cost. So the 50,000 is not relevant because this guy is still going to be paid. Whether we discontinue the Macharini, there is no way you can reduce his salary. So which means the operation manager's salary is
So, Lavma,
yes.
so meaning that in an actual fact, salary is not relevant because it will always be there.
Yeah, because if you check on the question, let me just go back there. What I want you guys to know is relevant. So it's 7. When we talk of it's on 4.4, when we are doing relevant costing, what you look at is it relevant to a decision? So when you look at relevant costing now, you look at if we take a decision of discontinuing, what is going to happen to this salary? Is this salary, if we discontinue, is it not going to be still paid? This guy is still going to be paid because he's now going to focus on the remaining products. So which means in our decision making, remember the answer that we want to have is an answer that tells us whether to discontinue or not, which means we should work on relevant cost of discontinuing and cost of not discontinuing. So that's basically what you look at.
Okay, I know, I get it now.
Yeah, that's basically how you work out when you are doing relevant. Don't put it in the same category with other costs, like when you are doing absorption and direct costing. You put it in relevant costing. It's just like yourself.
Yeah.
You want to go to town from your where you stay. You want to use your car. You are already paying for insurance, and you are going to buy fuel. The insurance cost, whether you go to town or not, you are still going to pay it. But the cost of fuel is relevant because if you don't go to town that day, it means you're not going to pay for fuel. So which means the cost of the insurance, whether you're parking your car, wherever it is, you're still going to pay it. So when you make a decision to go to town, you don't consider the insurance cost. You only consider the fuel cost. Right? So that's there on then let's look at number 4.5. The discontinuation will result in an annual saving in fixed manufacturing overhead. If we discontinue, then we save, then it means this will now go under discontinuation as an income. That's 145 will now go under discontinuation. So here we can now saving in fixed manufacturing overhead. So if we discontinue, it means we're going to save 145,000 in fixed manufacturing overhead. So we take it there. Then that one is fine. We are done. I don't think it needs much explanation there. Then they now say, if the margarine is discontinued, PBFD's total annual administrative cost of 2,800,000 will be reduced by 10%. What are we going to do? Is it relevant? Is the 2,800,000 relevant in our decision making? So which means the 2,800,000, the full amount is not relevant. It's an administrative cost, which means whether the discontinuation take place or not, the 2,800,000 is going to be there. So what we need is this saving in administrative cost. So it's going to be an income again and discontinuation. So this one is going to be saving in admin cost. So we are going to save 10% of 2,800,000. So how much are we going to save there? We just remove 1 0 there. So it's going to be 280,000. Right, then let's look at another one again. They say leftover direct raw materials that have been used in the production of the margarine will be sold to third parties for 10,000. Is it relevant? It's going to be relevant because if we discontinue the margarine, we are going to receive this income. So it's going to be a relevant income there. So if we discontinue and we sell those leftovers, we are going to get 10,000. So we take it here as income from leftover. We can say sell. So we're going to get 10,000. Right? Then we go to another. It's going to be, we did, so we are here. They say the pre-printed plastic margarine containers cannot be reused or sold. It must be discarded. What are we going to do with the discarding of the plastic margarine containers? It means they affect if we discontinue. So this is a discontinuing cost. Because they say the pre-printed plastic margarine containers cannot be reused or sold, it must be discarded at a cost of. So if we discontinue, it means we are going to meet this cost. So that's another cost that we are going to have there if we discontinue. Right. So this one is a straight figure. There is no calculation. It's 2,000. It's a cost. Right. Then let's look at the next one. Then 4.9 says PBFG contracts with Cold Wheels Limited to distribute the margarine at 1,800 per month. This non-cancelable contract expires on 31 May 2025. If the margarine product is not discontinued, the contract will be extended with the same terms and conditions. Cold Wheels does not have any other contract with soy safety. So what are we going to, is it relevant to our decision? If we discontinue, what is the cost of discontinuing and what is the cost of not discontinuing? I think here we need two. We need to look at the cost of discontinuing and the cost of not discontinuing. So if we don't discontinue for the next 2 years, it means we are going to pay for this contract 1,800 per month, which is times 12 times 2 years. That is if we don't discontinue. So which means we are going to take it as distribution cost. So in our distribution cost, we are going to say, if we do not discontinue, it means it's going to be 1,800 times 12 for the next 2 years. Then if we discontinue, what is going to happen? The contract is a non-cancelable contract. It's a non-cancelable contract. What are we going to do? It's a non-cancelable contract. So they say now, if we discontinue, it means the contract will run until here. The contract will run until here. Until 31 May 2025. That is if we discontinue. The non-cancelable contract expires on 31 May 2025. So which means if we discontinue, we still have to pay until here. We still have to pay until here. So how many months are we going to pay if we discontinue? So which means from our 2 years, we are going to subtract what? Remember, this one starts from 1 November. Ne? This one is from 1 November. So 1 November until 31 May, how many months are there for the end of the contract? So there is November, December, January. So there is 7 months here until here. So which means from our 2 years, we are going to subtract the 7. That is going to be our, so this one is going to be our 1,800 times, let me just say times 24 minus 7. I don't know if we are together there. Then this one is going to be 1,800 times 12 times 2. This one 1,000. So this one is, if we discontinue, we still have to pay until the expiry of the contract. But if we continue, we pay this amount. So let's calculate the one for continuing. So the one for continuing is going to be 1,800 times 12 times 2. So this one is going to be 43,200, the cost. Then this one is going to be 24 minus 7 times 1,800. 36,000 here. Right, so they were done there on the distribution cost. Then we go to right. Then the last one, it says the specialized machine use in margarine manufacturing. You have outdated technology and will be sold for at an accounting loss of 70,000 on 1 November 2024. The machines were purchased for 2 million and will have accumulated depreciation of 1,800,000 on 1 November 2024. And what are we going to do if we discontinue the manufacturing of the margarine? We are going to have to sell the machine at an accounting loss of 70,000. And the carrying amount is, no, they did give us the cost, and this is the depreciation. So what are we going to do with 4.10? There's an accounting loss there. That's the first thing that we should look at. What are we going to do with the accounting loss? An accounting loss is a non-cash, so it's not relevant. That 700 accounting loss is not a cash flow. It's not relevant. So that one is not going to be relevant. Then the next thing that we need is here. If we discontinue, it means we are going to have a profit on disposal of this machine. So we want to calculate how much are we going to get from selling this machine. That's the next thing that we need. How much are we going to get from selling this machine? So which means they say they sell it at an accounting loss of 70. So we need its carrying amount. Yeah, we need the carrying amount. So we are going to have proceeds. Right. So on the proceeds on the sale of the machine is going to be the machine cost 2 million. Then the carrying amount is 1,800,000. Then what else do we need? The accounting loss is 70,000. So this is what is going to give us the proceeds on the sale of the machine. So it's 1,800,000 from 2 million. 1, 2, 3. $200,000. Then there was a loss. So we minus 7 to the loss. Then we're going to get this proceed is going to be 130. It's an income, sorry. Right? So here, I will ask you guys to come up with the net relevant income. So what you do on your net relevant income, you calculate from the top for each, like from discontinue the margarine, do not discontinue. So when you give a comment, remember the question requires us to advise whether to discontinue or not. So when you give your comment now, you just check here. If this has got a higher net relevant income than here, then it means you have to discontinue. But if this one has got a higher net relevant income, then it means you don't have to discontinue. That's the comment that you have to make at the end there. Right? Unless it's this, so I would ask you guys to just calculate here. Then you can determine, once you do this calculation, what we have done here, that's what is needed. You'll find that this is, your comment might even be 1 mark or 2. Themselves, they just want you to do this calculation. So once you are done with this calculation, then you know whatever you get, even if your final answer is wrong and you have done 80% of the entries inside here correct, it means you are still going to get to pass on this question. Because when they mark, they don't mark your final answer, remember. They mark what you did here, these entries. This is what they mark. So which means if you have an idea of relevant costing, your entries must be at least 75% correct. Right? Unless if there is anyone with a question, then we'll meet for Mac on Wednesday. I don't know if you guys will be fine if we can have this Mac on until you guys write. I'm proposing for us to have it on Wednesday and Saturday. I don't know your availability. If we can do it twice a week like now.
No, I think it will be fine like that, love more.
Yeah, so that at
Okay,
least
no
we can
objection.
cover more. We can practice more. But what I would also ask you guys to go and to do, what you should do, like what we've been doing now, when you are doing it alone, don't just end there on the question and the answer that we have. Also go to the notes on relevant costing and try to see what are they saying about relevant cost. It is going to help you when you meet a question which is different from the one that you are doing. So referring to your notes is very important because the moment you are doing a question which is different, you apply this on your understanding of the whole topic. Right? So on Wednesday, we can start with the one, I think there is a question paper for 2022. So which means we can start with this, the one for MAC 3761, the one for 2022. Then after that one, I think there's another one for 2024. Then we see, as long as we still have time, we can go to some of the tests and try to see how they were done there. We can still be doing the revision. Unless if there's someone with anything to say, I think that's the end of our today's class.
No, I'm fine.